I have a winning trade for you today, and more importantly, I have some very good lessons from that winning trade for you today. In 2017, I was able to triple the return of the S&P 500. I was able to attain roughly a little bit over a 60% return in my portfolio in 2017, and I want to show you the exact steps that I took to do that. I'm showing all of my trades in 2017, the good ones, the bad ones, the winners, the losers, and sharing every lesson that I've learned along the way. In today's video, we're going to be talking about Resmed, ticker symbol RMD, and all of the lessons learned in that trade. Let's dive in. So there's a few lessons that we can learn from this trade in Resmed. First thing that we learn is that we want to look for trends on the weekly chart first. We are trading on an intermediate term time frame, and therefore we want to know what the longer term trend is doing. And so we were able to find our entry point on this week over here, the week of October 9th to October 16th, right in there. And we were also able to figure out where we're going to exit this trade to on this chart and see what it was doing and how it was breaking down on this longer term, intermediate term time frame. Second thing that we learned is that we want to identify trends on the shorter term time frame and find our exact entry point and our exact exit point on that daily chart too. And lastly, we see how all the different signals are going to interact and help us get out of this trade. So the idea for Resmed was for it to be an intermediate term trade, and we want to try to ride this intermediate term trend for as long as we can until the market tells us that it's time to leave. So we enter right here on this week, and I'll show you a daily chart too, but we enter on this week because we see this longer term trend, and you could see back here how it was kind of wide and loose, starts to tighten up over here, starts to tighten up over there, breaks out again, and then it's real tight over here, and it's getting support along this red curvy line. That is the 10-week moving average. So it's getting support there, and then it starts to rally. And so on the daily chart, switch over to the daily chart real quick, we enter right on that day, right when it starts to break out, and I'll zoom in a little bit more over here, and you could see how it was consolidating, and we could even draw another descending trend line this way over here too, and you could see that it starts to break out of that descending trend line, and then it starts to get confirmation on this day over here when it starts to poke its nose up and break out of there. We set our initial stop, and this is important to know too. We set our initial stop way down here at 75.17, so right below this low over here. And that may seem a little wide at first glance. Why not put it just below the 50-day? Why not put it just below this low over here? The reason why is because it's so tight to begin with. The difference between our entry point over here and our exit point down there was only a little over 3%. That's something that allows us to have a much more meaningful gain if the stock does run. Here's what I mean. So on ChartYourTrade.com, there is a position size calculator. And what this position size calculator allows us to do is figure out the number of shares that we can buy given the amount that we want to risk. So for example, let's say we have A relatively small size account. I know a lot of you out there trade very large accounts, but let's work with a relatively smaller account, $10,000, right? Keep the numbers nice and round, right? So we have $10,000, and let's say we want to just risk 1%. And so on our entry price of $77.70 and our exit of $75.17, we are able to buy 19, almost 20 shares. So you could either round up or round down depending on your risk tolerance. And that's going to allow us to put almost a third of our portfolio into this one idea and still only risk 1% of our trading capital. So if we lose, we're out 1%. If we win, like we ended up doing, and we had a gain of what became, just to skip ahead a little bit, 20%. So that's giving us roughly about 6 times the amount that we risked, a little bit more than that, almost 7 times the amount that we've risked. So on this one trade, if we are risking $100, we made $700 on this trade. That's how you end up winning in the stock market. We want to keep our risk small. We want to try to keep our risk constant. And then when we go for trades like this, where our entry point and our exit point are so tight, and then if it's able to run like this because we're on the longer term time frame, we're looking at bigger trends and waiting for the right moment to strike, we're able to find winners like these that pay. So this one trade, because we made 7 times the amount that we risked, that also means that if we're keeping our risk constant, that we could lose 7 times in a row and still be at break even. That's how this stuff works. That is our edge. But let's go through this trade. So we entered at 77.70 and our initial stop was at 75.17. As the trade progressed, we moved our stop up. We had that little bit of a gap up there. It started to move. The 50-day moving average caught up to below that gap, and it was at that point that we raised our stop to just below the low of this gap up at $81. The reason why we are waiting is because this is an intermediate term trade. If this were meant to be a shorter term trade, like a swing trade, then we would have moved our stop up much faster. But because we're trading on the intermediate term time frame, we want to make sure that we're able to capture these bigger moves and this intermediate term trend. And the way to do that is to keep the stop losses and to keep that loose as the trade begins to move higher and higher, and giving the trade room to work. The rules that we follow, the signals that we follow, are going to be different depending on the time frames that we're trading and the style that we're trading. It's so important to have a clear understanding of what time frame we're going to be trading. Can't emphasize that enough. That's something that used to trip me up to no end, and I would want to try to get these home runs, and I wouldn't because I would be scared. I thought that I would see a signal and exit, and then I'd wonder why this trade ran without me. Well, that's why. If you want to hang on for these bigger moves, you have to be willing to give up some of those gains to capture the bigger move. We want to try to raise our stop to break even as soon as we can, so that way we're able to free roll the trade. But once we do free roll the trade, we want to be able to allow that trade to work for as long as it can. So still running up, huge gap up, and we still are keeping our stop pretty loose because you can consolidate, and you want to again give this trade room to work, right? So nice gap up, looks bigger than it is, right? So from here to there, it's a gap up of about, for the high, it was a gap up of 20%, for the low, about 10%, finished at around 15% or so. Very nice gap up, but grander scheme of things, is 15% like that huge? I guess it depends on who you are, what you're trading, what your mindset is. But for us, we're trying to play for a much bigger move. So we continue to hold, and we continue to keep our stop loss relatively loose. Consolidates, pulls all the way back in just a matter of weeks. So huge gap up on January 23rd. By February 9th, it pulled back all the way, filled the gap. So a high point of, well, what is that? About 105, consolidates down. And so we give up almost 17%, right? So this is part of what we need to hold through if we're going to play this longer intermediate term trend. Whether you agree with that, or if you would have raised your stop up much more quickly, it all depends on what your style is. We need to be consistent. Part of the way to be successful in the stock market is, or any market really, is through trading consistently and following a consistent set of rules. Yeah, we could have raised our stop up over there, but then that means that we should have raised our stop up over here as well. And in other trades too, you could end up filling a gap, and then you could have getting stopped out, and then how do you get back in? Again, it's all about time frames. And just to look at the weekly chart too, on what that was doing over here, it was still support at the 10-week line, right? So you had your stop loss down here, let's say, and huge gap up, and then it came back down and it tested that 10-week line, and it's still getting support at that 10-week line. So it's scary to sit through, but these are the things that we've got to do. Back to the daily chart. Okay, so at this point, you could see that we start to rally again. We get chopping around, and we eventually get stopped out right over here at $93.52. The reason why is because now all of a sudden we're trading below the 50-day moving average, strike one. Then we are breaking support at 93.52, strike number two, and then we are breaking this ascending trend line, strike number three. And you could question why 93.52. It's this over here, right? So why not put it down at 92.75? Did we end up tripping 92.75? We haven't tripped 92.75 just yet. So why even put the stop there? It seems a little too tight. Well, actually, when I'm looking at this, it feels a little tight. So we put it over there because correlates to this weekly low over here, right? So if we're looking at the intermediate term trends, and we're trying to capture the intermediate term, we are figuring out where to place stops, primarily based off of the weekly chart too. Like we want to try to identify specific points on the daily, but it's more of where things are on the weekly chart. And over here, just below that week's low, and yeah, you could make the argument that, well, why not 92.75, or why not 92.60 to have that weekly low incorporated as well? And from my experience, that's how we start to play like a game of chicken with the stock. So it never really works out. Well, once you start to play that game of chicken with the price, for the most part, like from what I've seen, like you end up like giving yourself a much bigger headache there than what it's worth. If price is going to fall, it's going to fall. If it's going to rally, it's going to rally. Are you going to catch everything? No, right? Are you still going to have times when the market comes in and trips your stop and then runs up? Yes, you will. Is that the market maker trying to get you specifically? No, that's just the luck of the draw, really. It's where you placed your stop and it's where we're going to get out. Is there a magic number where you won't get stopped out? No, it's all about how are we going to manage risk and then accepting that risk of where we're going to put it in. We could agonize over a few cents here or there, but what I've found is that it's much more capital preserving, both mental capital and physical capital, to just find the spot, put it in, and to try not to overanalyze where to place that stop. And so long as we are there and we are capturing the bulk of the move, that is what's more important. We want to capture the bulk of the move. We're not going to capture the exact high, and we're not going to get out at the exact low. It's capturing the bulk of the move, capturing the bulk of those trends, and that is what is going to allow us to have years where we triple the return of the S&P 500. So I have a special bonus offer for you. If you'd like to follow along too and see how we are exiting, how we are entering trades, how much we're risking, how we are managing the model portfolio, you could sign up and test it out for 3 whole months for only $27. Use coupon code YouTube and click the link. I'll link it somewhere up here, and I'll also have a link down in the description below. Click that link and use coupon code YouTube, and you'll be able to test out this advanced stock report service where we are giving you all these trades, giving you tons of research, giving you intra-week updates, and giving you direct access to ask me any questions and to ask my partner, Adam Sarhan, who writes for the service, any questions. Take advantage of it. Use coupon code YouTube and test it out for 3 whole months for only $27. It's a fantastic deal. Go check it out. Thank you all so much for watching. I truly, truly appreciate it. If you have any questions at all, please leave them in the comment section below and I will personally help you. Also, if you like this video, click that thumbs up button. That's really going to help us out a lot. And make sure that you subscribe to the channel so that way you get every single update. Thanks so much for watching, and I'll see you again in the next video. Take care and have a great day.